All right, welcome everybody. Shane Carter here, along with me, our VP of Investor Relations, Eddie Austin. How's it going, Eddie?
It's going great.
All right, great to have you on here. This is our webinar for Springbrook Lofts, formerly known as. Currently, we have rebranded the asset to be the Lofts at 3402. And this is our webinar around our Class C investment capital raise that we're doing right now, with a total raise of $750,000 that we're looking to do on a first come, first served basis, with a minimum offering of the investment of $50,000. So let's kick this off, Eddie. I'm going to show this
Our one page.
our one pager. Yep. And so, again, this is in Houston, Texas, in Spring Branch, a very nice area of Houston, Texas. We're offering Class C shares, which is a new class of shares that we have created for this, with a 12% preferred return on it. We have a 2 to 3 year time period on this. We will look at a potential exit in 2 years to improve upon these returns, but everything you see here is modeled on the 3 year to be more conservative. We've got just under a 30%, a 29.1% average annual return, and a 1.58x equity multiple for this investment. Again, $750,000 raise target with a minimum investment of $50,000. We have a 104 unit asset, but that is on a very strong upward trend, pushing 90.5% in terms of occupancy, and going to be growing from there here over the next 60 days. So again, as I said, this asset's located in Spring Branch, and very desirable school area. We got 7 buildings, about 74,000 square feet on about 2.5 acres. We've implemented the business plan, 100% renovation on the units. We have a new property management company in place, and we again are offering a 12% pref return. We will show this information again at the end. Contact Eddie for more information. But we wanted to really get into an understanding of some of the questions and answers that we've been getting, and produce this webinar so that we could answer as many questions as possible for investors.
Yes, absolutely. So we've been pushing out through our email list. Anyone that's not currently on our email list, please sign up by downloading the ebook or contacting me on our website, which is hampshirecapital.com. So on this opportunity, we're super excited about this because of this Class C share, which is a 12% preferred return. Mm-hmm. And with addition to, there's also participation in the waterfall as well.
That's right.
So a few questions that we had got from our email blast was, number one, investment timeline. How quick are we deploying this capital, and when does return start? So, yep. As far as the lockup period, we're talking 2 to 3 years. As far as how quick is your money invested, it's invested as soon as it comes through our portal, which run a portal through InvestNext. We will share a link to that where you can sign up. This is a 506c offering, so this is for accredited investors. And you'll do your accreditation documents, go all the way through the pipeline, and it is a $50,000 minimum investment. And please correct me if I'm wrong, Shane, but we will be paying returns on any returns quarterly.
That is correct. But before we dive into more of the kind of in-depth Q&A on the property, I wanted to give a quick overview and a quick background, and maybe some of the kind of first order questions that we should really talk about are, when did you buy the asset? Why are you raising money now? And what's going on? So we closed on this property in May of 2021. So just almost 2 years ago on the nose, just over 2 years ago. And why are we raising this money now? Is because we had a very unfortunate circumstance with our prior property management company. and a prior property manager at the asset that we've had to part ways with both of them on just a few months ago now, and brought in new management, a great group right there out of Spring Branch called Banyan Equity, and they're doing a fantastic job managing the asset. But unfortunately, what happened is they uncovered a little over $500,000 in aged AP that was allowed to accrue on our books, and the prior management company did not put that into Entrata, which is our property management software. We were not made aware of it. We did not condone it or sign off on it, which is a complete breach of our property management agreement. And obviously our property manager as well was aware of that and did not take any protocols to make us aware of it or let us know what was happening. And so, we are pursuing every reasonable action according to law that we can pursue against those parties that have committed this, what we believe to be fraud, and a negligent treatment of our prior management agreement with that firm. And we will be pursuing the highest level of justice that the Harris County and the state of Texas will afford us. So that is what has happened, and that's why we unfortunately are in the place to raise this money. Another question that has come up that investors have asked is, well, look, don't you guys have any reserves or capitalization reserves for the property? We did. We had about 200,000, and a small amount of that went to pay some of the most egregious or current aged AP that we had on the property, where folks were about to put liens on, and we created payment plans and got them some capital quickly. And the rest of that, unfortunately, got sucked up into a doubling of the insurance rates on the property that we just had to pay 2 months ago, that we had no forewarning on, no advance notice from our insurance broker. And he claims that there was no way that he could have known that those insurance rates would have jumped that high that fast. We were planning on about a 20% increase, about 15 to 20%. And instead we had a 200% increase. So that really took the rest of our cash reserves right off the table on this property. And that's why we don't have those cash reserves today. And so again, the $750,000 that we're raising now.
I know for a fact,
Sorry, go ahead.
No, that's fine. You'd cut out for a second. I know for a fact that we're extremely pleased with the performance of our actual property management company now, just for the amount of stuff that they've been able to dig up, open up to our eyes, and they've done a tremendous job of finding evictions that weren't filed, things like that. So there was a tremendous amount. The occupancy rate previously was not a true statement.
That's exactly right. Yeah, and we'll dig into some of that. But just to kind of conclude that, the reason we're raising $750,000 now is that we've got, about $550,000 in AP that we've got to clear up, and then we want to replenish that $200,000 capital reserve fund that is currently depleted, and so that's the full sort of sources and uses, if you will, for the capital.
Mm-hmm. Mm-hmm. Absolutely. Well, I know a lot of people experience the insurance issue, especially in the Texas area.
Yes. So look, let's just kind of maybe go back and forth in terms of the questions. I know you've got a bunch of questions that you've had, and I've got a bunch here as well. I'll do one of mine first, which is, we got a question from existing investors, right? We have a number of Class A LP common investors in this deal currently, of course. And one of the questions is, well, look, am I getting diluted now because of this new class of shares? The answer is 100% no. You are not being diluted at all. In fact, obviously, we believe this is a fantastic opportunity for folks who are already invested in this asset to increase their returns by increasing their investment and understanding, the business plan, understanding where we are and the job we've done so far. We're just producing enhanced returns, and the only dilution that's occurring is on our side. Class B members of the general partnership have agreed to dilute our shares to create this new class of shares that is going to get outsized returns over the next 2 to 3 years at the most for the investment. And so our existing investors are 100% locked in with the returns they're getting. They're not getting diluted one iota. It's really just the Class B members that are experiencing the dilution.
100%. So one of the things that came up in one of my phone calls was debt structure. So can you touch on the debt structure we currently have on this property?
Absolutely. We've got about $6.75 million in fixed rate Fannie Mae debt on the property, fixed at a 4.2% interest rate, and that is through the life of the loan, which is a 5-year product. So we've got 3 more years on that. I'm sorry, it's a 10-year product. 3 more years of that in interest only. So we've got 5 years of interest only, 3 more left because we've just owned the asset now for 2 years, and so we're locked in with a great debt product. That's why we're not scrambling. That's why we're not raising $2 million here. It's really just to clear up that aged AP that unfortunately due to that fraud and negligence on the prior management's fault is really why we're sitting in this situation right now. Otherwise, the asset's doing well. And we're in a good place.
Yeah, I know one of the hottest question that came up was no bridge debt. And no, we do not have a bridge loan. No. There's no high interest mezz. There's nothing like that in place. There's no pref equity. There is pref equity in this, or there's not?
There is, yeah. There's pref equity in it, but again, it doesn't. It's a soft accrue. So in other words, if there's not cash to pay it, we can't pay it. But obviously, we're excited to get this property back on track to pay our pref equity firm as well as our LP investors, which we project we'll be able to do by the end of the year from cleaning up this sort of aged AP challenge that we have right now, and be able to push the asset. The asset's already, paying all of its bills and sort of, not accumulating any additional debt at all, and starting to accumulate additional cash flow on a month-over-month basis as we speak, starting this month. So we know that clearing up the aged AP is going to allow this property to continue to build that NOI and continue to build that cash reserve buffer, where we can start making pref payments, hopefully as early as Q4 this year.
Yeah, 100%. The next one that I had was we checked off the debt structure payouts. So, some people pay monthly. We always pay quarterly, and that would be the case on this opportunity as well. We'd pay quarterly returns.
That's correct.
The other one was investment timeline, which you touched on already. Number one was, how long is this? We're 2 to 3 years on this opportunity.
Yeah, and let's just drill into that just a quick second. Why do you say 2 to 3 years? Well, that's because we project that in 2 years, we're going to be in a place, number one, that has a more favorable capital markets condition, which I think we'll all agree that, we're sort of in the worst of it right now. Right. So when we fast forward 2 years, we know that we believe we're going to be in a substantially better capital markets condition relative to being able to trade the asset for a solid value and a solid cap rate. With lower interest rates, et cetera, et cetera. Also, that's the time period that allows us to get our pref equity firm to over their kind of minimum equity multiple hurdle. And so we've always needed to hold the asset for at least 4 years. Our business plan's always been 5. But we knew that we'd look up in year 4, which is 2 years from now, and start to get BOVs and test the market and understand what that looks like. But if we don't like what we see, we'll just wait another year and continue to get the cash flow and continue to make the pref payments and continue to drive the NOI higher and higher for an even better future exit price for our investors. So that's why we have that range of 2 to 3 years.
Yes. And in my opinion, it's always best to let us operate the property until we see fit to execute our exit plan, because it's only incentivizing investors to stay in longer because there's going to be a bigger chunk of the sale there's going to be a higher dollar amount of that sale that's going to be, of course, split over the waterfall and any accrued pref.
That's right.
The next one was the pref and the waterfall. So I've had a few people ask, okay, so it's a 12% preferred return,
Yep.
but do I also get to participate into the waterfall structure? And yes, you do.
Yes, that's right. So this is again a new class of shares that we're diluting the general partnership members to create. We're giving this new class of shares a 12 pref, right? The original Class A shares have an 8 pref. We're giving this new Class C share a 12 pref, just to further incentivize and affirm those return metrics that we're providing them. And then it's also a first money out in the waterfall provision. That waterfall is a 75-25 split. And so, capital goes back first, capital gets returned, then a 12 pref gets paid out, and then they participate in the 75-25 waterfall split at the same level that our Class A shares receive that waterfall as well. And again, it's not diluting the Class A shares, though that capital is coming out of the Class B shares in dilution to create the additional shares for Class C shares, which is what we are currently offering.
Correct. And the last question I had on my list was tax structures. So a lot of people have asked, because of some of our previous capital raises, some of the K1 losses they were able to collect. Essentially, this being a property that we're bringing in secondary class of money, there probably will not be, or there won't be, any type of a tax incentive or K1 losses. Would that be true?
Yeah, so true in the sense that there won't be any cost segregation or bonus depreciation. That was obviously done, 2 years ago when we bought the asset.
Right.
But there is continuing to be K1, losses that accumulate on a year-over-year basis going forward, just at a lower dollar amount, obviously, than the bonus depreciation. But any of those K1 losses that accrue to the property will be split out pro rata again to those Class C members in accordance with their share value.
Mm-hmm. The only other thing I had on taxes was I had one question around property taxes. Do you feel like the property taxes could go up even farther than they are, or do you feel like there'll be a pretty good snapshot of what we know that we're going to look like for the next 2 to 3 years?
Yeah, good question. And look, nobody has a crystal ball. However,
Right.
Owning assets now in Harris County for a number of years, obviously there's an annual litigation process that happens that we're successful in every year. And so, if you look at our track record of where the property is on a tax basis year over year, going back the last 3 years, and not only on this property, but other properties we own, we are very confident in the stability of our tax projections. Having said that, we always project for taxes to go up, right? And so on a year over year basis, our business plan, our pro forma, and our modeling does have taxes going up. To date, as of 2022 taxes, we are actually at or under our projections for our tax basis. So we feel sufficiently confident in a go-forward basis as well.
Fantastic. Well, that's all the questions that I had. Do you have anything on your list?
Yeah, no, that, I guess the only other thing that I would add is NOI growth. We have executed the business plan, but because of the aged AP and because of some of the mismanagement we experienced, our current NOI is a little bit off of where we intended to be. And so what we've seen over the last 3 months of management on this asset is that every single month the NOI has grown by a factor of about 5 to 10%, which is fantastic. And we are well on track to hit our NOI projections by the end of next year. So by the end of 24, which is well in advance of our 2-year minimum cycle turn. So we feel like from a business plan perspective of where we are now and where we're going, that we have a very clear path to execute and a control of all the variables that can affect us at this time.
Absolutely. I want to go over ways to contact us. The absolute best way to do it is visit our website. Also, by all means, on our website, you'll see our portfolios that we own.
Yep.
You'll see our track record.
Yeah, we'll put a little button right up here for everybody to be able to click on.
Yeah, absolutely. Yeah. And schedule it. If you download the ebook or schedule a call, you will get on a phone call with me, or if not, a Zoom. And I'm happy to answer any additional questions at all. Anything you have, please bring them my way. And we are looking to, at minimum, in the next week, meaning this week that this is going out, raise at least $100,000. So we're going to need at least 2 investors for $50,000 apiece, or a nice $100,000 check. So let's talk about $100,000 invested. What does that look like?
In terms of the returns?
Yes.
Yeah, so on $100,000, obviously, at a 12 pref, you're looking at $12,000 a year in that pref payment, and then an additional, I believe it is an additional $14,000 per year in projected retained earnings, and that is just exit sale proceeds. So in other words, we didn't project for any additional pref payments or cash flow over the next 2 years, right? We left ourselves conservative in that way, which of course we do expect to pay pref payments and hopefully, cash flow over and above pref payments over the next 2 years. But let's just say worst case scenario, we didn't. Let's just say we didn't pay out a pref payment or a cash payment for the next 2 years. That is what our projections are here in terms of a 29.1% average annual return, right? So that means, again, you're 12,000 in pref plus another 17,000 in retained earnings, but that doesn't even include what your pref payment on an annual basis or any additional cash flow would be, which would just drive those annual returns even further.
Mm-hmm. Yeah. So I think that hit everything on my list that I can think of. We know what it looks like for someone to invest $100,000, and equity multiple. That was the last thing that was just a side note.
Yeah, again, we're looking at it was a 1.58 that we're projecting for a 3-year hold. So if we do it in 2 years, that number could change a little bit. But also that number does, again, not include any additional cash flow from the property. We wanted, again, to be conservative in terms of how we're projecting returns and not sort of overpromise. And so that number certainly could go up, but for a 2 to 3 year hold, that's a pretty good equity multiple.
Yeah, absolutely.
Yeah.
So to summarize here, we know for sure that we are a 29.1 AAR. We know that we're a 1.58 on the equity multiple, and we're looking at a 12% preferred return.
That's right. Exactly right. And a preferred position in the stack in terms of sort of what we call last money in, first money out, right? So a preferred class of shares that's going to get their money back first and going to get their pref payment first as well.
Fantastic. So again, everyone, please, by all means, reach out to us, go to the website, click the link in this video, follow up with me. I'm happy to jump on a call at any time. Just schedule it and answer any questions. I'll send you the OM, send you anything that you need, any type of property financials. We're happy to share this stuff. We are extremely transparent in our business plan. We're happy to share anything that you have questions on, and just let us know. We're here to help you do a lot better than the stock, bonds, and mutual fund market. We're here to give you a real estate option that is brick and mortar. This is a real piece of property. It's a real address. It's not an IP address. You're investing in real estate, real property.
Yep,
cash
absolutely.
flow real estate. So thank you all.
All right, Eddie. Thanks for everybody, and we'll have notes in here and direct links to our website and offerings from here. And we look forward to hearing from you. Thanks so much.
Thank you.